Welcome to This Explainer. Today, we're dissecting the core mechanics of corporate finance and uncovering the sometimes surprising forces that truly drive a company's decisions. We all interact with massive corporations every single day, right? But we rarely stop and think about the fundamental rules that actually dictate how they behave. So, before we even look at theories or financial metrics, we've got to start with a really basic question. Who actually pulls the strings in a corporation, and what is their ultimate goal? It's super easy to just assume a business wants to make money, but as we'll see from the source material, the reality is a much more intricate web of competing interests and really delicate balancing acts.
All right, here's our roadmap for today. We're going to cover 1. The ultimate corporate goal. 2. The social welfare connection. 3. The stakeholder balancing act. 4. The agency problem. 5. Carrots, sticks, and governance. And finally, 6. Measuring true success.
Let's kick things off with Section 1, the ultimate corporate goal, the prime directive. We need to start right at the absolute foundation by defining the core objective of corporate financial management. If you look at the classic textbook definition, it's actually pretty straightforward, but it's incredibly powerful. Financial management exists to maximize the wealth of the shareholders. In the private sector, that usually boils down to a very specific target: maximizing the price of the company's existing ordinary shares. Literally everything a financial manager does is, theoretically at least, reverse engineered from that single overriding objective. So how do they actually pull that off? Well, to maximize that wealth, the financial manager basically has to juggle three critical decisions. First, the investment decision. Where should the firm profitably deploy its cash into long-term projects while weighing the expected returns against the risks? Second, the financing decision. How do they actually pay for those investments? And third, the dividend decision. How do you divide up the earnings? Do you pay out cash directly to the shareholders right now, or retain those earnings to fuel future growth? It's a constant tension, because immediate payouts and long-term growth, they often clash.
And that financing decision I just mentioned, it's a huge balancing act. The goal is to find the absolute perfect mix of raising money through equity versus taking on debt. You're trying to find that optimal capital structure that maximizes the company's overall market value. Tweak this mix and you change the total value of the company, which makes it one of the most vital levers a manager can pull.
Which brings us to Section 2, the social welfare connection. Is maximizing share price evil? I mean, if a firm's sole purpose is just to pump up its share price for the owners, it sounds entirely self-serving, doesn't it? But surprisingly, the source notes that in a reasonably competitive economy, actions that maximize share prices generally benefit society. Why is that? Well, to push that share price up, businesses have to compete to create wealth, and that naturally directs scarce economic resources to their absolute most productive uses. Assuming a firm isn't acting illegally or unethically, chasing higher stock prices actually aligns pretty well with the public good. Let's break down exactly how society wins here. First off, the owners of these shares. They're largely everyday citizens, whether directly or indirectly through things like pension funds. Second, consumers win big time because share price maximization demands efficient, low-cost operations that crank out high-quality goods and tech innovations. If a firm just price gouges, competition ensures they're going to lose market share anyway. And third, employees benefit. The source points to surveys showing a really high correlation between a company's ability to create shareholder value and its ability to attract and keep talented employees. Successful companies grow, they hire more people, and they provide way better job security. Moving on to Section 3, the Stakeholder Balancing Act. Who else is in the room? Look, maximizing shareholder wealth sounds fantastic in theory, and it clearly has broader economic benefits. But shareholders aren't the only ones whose lives are impacted by a business, right? We have to consider this massive, complex web of stakeholders. You've got employees wanting higher wages and safe working conditions, you've got suppliers wanting to be paid on time, and creditors demanding secure loans. Then there's the government, looking for economic growth, safety compliance, and, of course, tax revenue. And don't forget the wider community, expecting green policies and local support. Every single one of these groups has distinct and often totally conflicting objectives. And this brings us to a major complication. The source explicitly states that the simple textbook theory of maximizing shareholder wealth, it's just too simplistic for the real world. Why? Because financial objectives constantly have to be balanced and sometimes even compromised to satisfy non-financial goals. Whether it's prioritizing employee welfare, taking care of customers, or minimizing pollution, these non-financial objectives cost money.
They reduce short-term profits, sure, but they are absolutely essential for long-term survival.
Let's dive into Section 4, the agency problem, the conflict of interest. Yes, a balancing act is required to keep all these stakeholders happy, but what happens when the people actually running the company day to day don't want the same things as the shareholders who own it? Welcome to the agency problem. This is a fundamental conflict of interest baked right into modern corporations. The principals, the shareholders, hire agents, the managers, to run the firm. Now, the shareholders want to maximize wealth, and they're usually fine taking on calculated risks to get there. But the managers, they're human. As their personal ownership stake decreases, they might start prioritizing their own rewards. They might want high salaries or to build these massive corporate empires just for the social status, or they might completely avoid profitable risks just to keep their own jobs safe. And actually, this agency problem doesn't just stop at the managers. There's a secondary conflict between shareholders and creditors. Creditors lend money expecting safe, predictable cash flows. But shareholders, acting through the managers, might want to take on highly risky projects. Think about it. If a risky project succeeds, the shareholders get all the upside. But if it fails, the creditors are the ones left holding the bag on the lost assets. This is exactly why creditors insist on strict debt covenants, rules that restrict selling off assets or limit dividend payouts, just to protect themselves from shareholders gambling with borrowed money. Section 5. Carrots, sticks, and governance. Aligning the objectives. So if human nature and differing financial stakes cause all these intense conflicts, how do we actually get everyone on the same page? To achieve what the source calls goal congruence, companies use reward systems. Think of these as the carrots. By tying a manager's pay directly to profits or rewarding them with shares and share options, you totally change their motivation. Suddenly, the manager personally benefits when the company's share price goes up. It's a really powerful tool to align the agent's desires directly with the principal's goal of wealth maximization. Though it's not perfect. If it's not designed carefully, it can sometimes encourage short-term thinking. And then, of course, we have the sticks. These are your corporate governance codes of best practice. Good governance is all about accountability. You definitely don't want too much power in one person's hands, which is why the roles of CEO and chairman are typically split up. You bring in independent non-executive directors to keep an eye on things. You set executive pay through an independent committee, so managers aren't just writing their own blank checks. And you enforce regular audits and risk reviews to keep everything completely transparent. Which brings us to our final section, number 6, measuring true success, beyond the bottom line. How do we know if this incredibly complex balancing act of financial goals and governance is actually working out in the real world? Well, to assess true success and build a complete picture, companies have to look at a whole matrix of metrics. It's not just about the money anymore. You have to balance traditional financial indicators like cash generation and return on assets against absolutely vital non-financial indicators. We're talking about things like market share, which proves your product is viable, customer satisfaction, which ensures you'll have future revenue, and your overall competitive position. So, the really crucial takeaway here is this. Profitability is the standard metric we all hear about on the news, right? But the source heavily criticizes relying on it alone, because profitability limits an organization's focus to just one output measure. It doesn't explain why one business sector has better prospects than another. It ignores the internal dynamics of the company, and honestly, it completely overlooks the quality of the product being delivered. If you chase profit while sacrificing quality, you're going to lose your market share eventually anyway. So as we wrap up this explainer, I want you to think about this the next time you interact with a major brand. When you buy a product or see a headline about a corporate merger, do you just see a wealth-maximizing machine relentlessly chasing profits? Or do you now see the incredibly delicate, constantly shifting balance of competing stakeholders